Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Good morning and good afternoon, ladies and gentlemen. A warm welcome to this new episode in our Focus On series. This time we are bringing to our friends in the United States a short summary of 90 minutes of Luxembourg. We want to show you what has been happening in various areas pertaining to the financial services industry in the Grand Duchy. We will touch on what Brexit has brought about, the asset management industry, then recent changes and evolutions in the tax environment, and obviously, for the last bit, fintech and payments. My name is Nicolas Machiel. I'm the CEO of Luxembourg for Finance and thus the host of this conference. I would like to start, first of all, by welcoming, acknowledging also my friends and colleagues from the Luxembourg Trade and Investment offices in New York and in San Francisco, who have so efficiently helped us in spreading the word about this and who on a daily basis represent Luxembourg's economic interests in the United States. I would also like to acknowledge our friends from the Luxembourg American Chamber of Commerce for their very kind help. Now, let me start by bringing you back a little bit on an issue that has, at least on the continent and in Europe in general, been at the forefront of the news, Brexit. Brexit has, after 4.5 years of high political drama, now been done, to use the formula of the British Prime Minister. What has it meant for the financial industry? Have we seen on January 1st, when the transition period expired, finally, eventually, any sort of upheaval? No, none, hardly any. We saw, yes, a few switches to venues in Europe, on the continent, for trading, but overall, it was a very smooth end of a transition. And the very simple explanation is that while the politicians were busy with exchanging sound bites, the financial industry was busy preparing for the world after the UK had left the European Union. And as you could see from many media reports, they have chosen various financial centers to relocate different activities. According to the New Financial, which has published recently a report, Luxembourg has seen 92 such relocations. Allow me to take you a little bit into the detail of these, just to explain to you on the basis of these relocations why firms in these different areas choose Luxembourg. The first, obviously, is in the area of asset management, because that is where the bulk of these relocations happened for Luxembourg. Luxembourg, as many of you will know, has always been an established fund structuring center. We have just crossed the threshold of 5 trillion euros assets under management. That is not Brexit related, that would have happened anyway. Why did so many asset managers then choose Luxembourg? Well, because first and foremost, they already had, to a very large degree, operations, and quite sizable ones at it, in Luxembourg. Indeed, most of the asset managers had a large presence for their retail funds, UCITS funds, in Luxembourg. So with Brexit, what we have seen is that, yes, those that may not have had a UCITS platform in Luxembourg have also opted to switch it either to Luxembourg or, in the other alternative, to Dublin. But in many cases, it was mostly in the area of alternatives funds, because those had been set up previously largely in London. And they, at least those that have other investors from the continent involved, needed to find an alternative. Also, what we have seen is that a number of firms have moved to Luxembourg their MiFID entities. These are investment advisory services, for instance. In and of itself, all these moves do not change history for Luxembourg, but they do confirm Luxembourg as one of Europe's, if not Europe's, leading asset management and fund structuring center. Another area where Luxembourg has scored very highly was that of banking. Now, not necessarily in investment banking, trading or wholesale banking, but rather because Luxembourg has quite a standing when it comes to wealth management. We have seen, for instance, very large corporations and very large American corporations at it, JP Morgan, Goldman Sachs, Citibank, set up in Luxembourg their post-Brexit EU wealth management hub. That tells a story in and of itself about the expertise that is available in Luxembourg and, of course, also the toolbox that Luxembourg's regulatory framework offers for wealth management. Other banks, for instance, Northern Trust from Chicago, has set up its post-Brexit EU headquarter in Luxembourg for the asset servicing activities. They had a presence in Luxembourg before, and yet they set up their EU headquarter in Luxembourg after Brexit. There are other banks, such as Canada's CIBC, that set up a capital markets operation, or Asian banks that have also chosen to move activities to Luxembourg. An interesting activity also we saw in the area of payments, where Luxembourg had already been quite an established hub before Brexit, with the likes of PayPal and Amazon Pay having chosen to set up their EU operations in the Grand Duchy. And this probably is what attracted other giants like Alipay or trendsetters like Airbnb or Satispay and others to relocate their EU hub post-Brexit to the Grand Duchy. Now, one interesting area was that of insurance. As some of you may know, the insurance industry was very largely concentrated in London around the Lloyd's market. And with Brexit, they were also forced to choose an alternative venue for their EU operations. 13 of them, and to a large degree, the big ones, have chosen Luxembourg for their post-Brexit operations, such as AIG, the world's largest, but also Liberty Mutual, CNA Hardy. And then even anecdotally, but nevertheless importantly, the US Army has chosen Luxembourg for the insurance company that it has created to offer insurance coverage for the private use of its US military personnel stationed in Europe. That also tells a story. Now, what were the reasons for choosing Luxembourg? I think in all of these cases, it was primarily the existence of the ecosystem. An ecosystem that is best geared to serving these activities: asset management, wealth management, payments, and of course the insurance industry. Second, of course, also the stability of the country. Luxembourg is one of the very few countries, 10, that still have a AAA rating with the highest outlook from all major rating agencies. Our public debt to GDP ratio, still, with all the expenditure that we had to go through now during the pandemic, is below 30%. That is nearly half the Swiss public debt, a third of the German public debt, and I spare you comparisons with others. And then, of course, it is the international dimension of Luxembourg. The fact that you can come here, you have a population that is to a very large degree multinational. This also brings about a multilinguality. You find people who speak many languages, and even, very importantly, the Luxembourg authorities that not only use and are able to, but accept to communicate in English, both in writing and orally. Now, where do we go from here, ladies and gentlemen? Brexit, as I said, has confirmed Luxembourg in certain areas, has consolidated its activity. The EU also has to acknowledge the reality of Brexit by deepening the single market. And I think that is one area where we will all be working on, whether it is Capital Markets Union, the Digital Single Market, or the Green Deal. All of these will combine in order to make the single market even more efficient, even more open, even more flowing, and thus excellent for the business of any financial institution wanting to tap the still 450 million reasonably wealthy consumers in the EU. And Luxembourg will certainly push in that direction. Ladies and gentlemen, I will at this stage hand over to the next panel. Before doing that, please allow me also to thank our sponsors who have supported us in this episode. They are all Luxembourg service providers and advisory firms that are also obviously very interested in the US market, many of them even with a presence in the US, in New York or in other places. It is now for me to hand over to our colleague, Serene Steyer, from PwC Luxembourg. And Serene will moderate a panel of experts on the asset management industry. And I will be back at the very end for closing remarks. Thank you very much.
Good morning and welcome everyone to our panel, Adapting to a New Normal in the European Asset Management Industry. By way of introduction, my name is Serene Steyer, as Nicolas mentioned. I'm a partner at PwC here based in Luxembourg. I've been with PwC for the last 25 years, and within that 25 years of experience, I've focused almost exclusively on the asset and wealth management industry, more specifically with clients based out of the US. So we have with us today a great panel with a broad spectrum of experiences and roles within the asset management space. If I can start with just some quick introductions. To my left, Jean-Marc Goy. Jean-Marc is known to many of us here in Luxembourg not only because of his long experience at the CSSF, but also because his prominent role at Capital as conducting officer, but also senior legal counsel. Then I have Catherine Pogolowski, who's a country managing partner at DLA Piper. Revel Wood at the far end. Revel is the co-founder of One Group Solutions, which is a third-party management company offering services to clients globally who are based here in Luxembourg. And virtually with us today, and maybe that's part of the new normal, we have Deirdre Ryan, who is in charge of client management at State Street here in Luxembourg. So thank you all for joining us. So if we reflect back just on the past year and look at the industry specifically, obviously the pandemic has caused huge disruption to the industry everywhere in the world, not only in Luxembourg. But I think we can all agree that when we look back at it, the agility and the speed with which the industry and all the service providers really, or the players within the industry, have been able to adapt very, very quickly to the circumstances. And I think that shows great resilience. With that, what we wanted to do today is really discuss what were some of the significant changes that the pandemic has caused, and what were some of the lessons that we learned and now have become part of the new normal in the asset management space here in Luxembourg and in Europe overall. And so if we could jump right into it. Deirdre, if you don't mind, I'll start with you on some of the operational aspects. Anyway, before the pandemic, I would say that home-based working and flexibility was something that everybody was kind of starting to move towards. But then, of course, because of the lockdown, it was a very quick shutdown and everybody was working from home. And of course, as I mentioned earlier, everybody within the industry had to very quickly adapt to those circumstances. And so if you could share with us some of the challenges you saw in the industry, maybe specifically at State Street, but generally within the industry. And again, what did we take away from that has now become part of the new normal?
Sure, thanks, and good afternoon. Good morning also to everybody. Yeah, so look, I think you've picked up on a few of the points there. Working from home, certainly within State Street, was already something that we had in place as a policy. We also had, operational hubs globally around the world that made the whole, early weeks of the pandemic, helped to alleviate some of the stress on that, and we were able to transfer various functions around because of that framework of the operational hubs that we had, and also because we were able to have very open and pragmatic discussions with the regulator, the CSSF at the time. So the key disruption was really, I suppose, deploying on a large scale, people back home, and the framework was there. We just had to do it at a much bigger volume than we had before, and we saw that across our peers and with our clients as well. And by and large, it was deployed successfully. Groups were able to operate as they normally would. So I think the key change really, and where we had to focus, was on communication and how we were going to ensure that that communication happened effectively and continued around operational teams and also around our peers, etc. So that was where a lot of the focus was, and that was the big disruption, was making sure that we had that in place. In terms of what is here to stay, I think it's very much the hybrid working place, and that's where I think that's one of the aspects of post-pandemic that we're going to see. So designing for a workplace of the future and what that looks like from a practical perspective, making sure that we're designing workplaces that accommodate the new hybrid, but also allow for meaningful collaboration and interactions with people. And I think that's certainly where the focus is at the moment, and getting ready for that, and making sure that what we're setting up works. The people aspect is also very important, making sure that we have people who are engaged, continue to be engaged while they work remotely, and also while they work in this kind of hybrid where part of teams may be in and part of teams may be out. So that's something that is very much being worked on. I think we see that across our discussions with clients and our peers as well. So culture, mental health, definitely top of the agenda. I think one of the other things that we've seen in terms of challenges or things that are here to stay, one of them that stands out to me, I think, is probably the agile responses to issues. That sort of shift in mindset around kind of more rapid assessment of situations, more rapid assessment of solutions and risks and how we mitigate. And I think that shift is here to stay as well. And if I just look at simple examples like the use of e-signature becoming much more prevalent, and I don't see that going away. So all that sort of good thought process continuing on into the future.
Any other thoughts from any of the panelists with regards to big changes in the operations?
One thing that's interesting is you would never have thought of making a kind of FaceTime call to your colleagues here. Yeah. I did it remotely where I had teams in Ireland or Singapore previously, but I always thought it's such an intrusion. Now the concept of a telephone call without FaceTime, and I think it's far more personal and it's great. So I think there's a lot of positives that have come out of it. I think also changing the flexibility of working, whether people are working in the office, you can still, people will come back to the office. I don't think everyone's going to work from home forever. But the flexibility of being able to choose when you come in, rather than everyone sitting, especially long cross-border commuters, for an hour and a half, why not log on, work a bit, come in at 10, rather than you don't need to be in at 8 anymore. I think it's created an environment where we can be more efficient and also from the social perspective, work-life balance improves.
Yeah. I think our industry is quite special, actually, in the fact that we have so many people that we have to connect with, so many different vendors and service providers that are involved when you have a platform based here or anywhere, I guess, in Europe, right? A fund platform. Jean-Marc, from your perspective, what were some of the challenges in that? When I was speaking to some of my clients going through the pandemic, a lot of them realized that the way they were structured was maybe too heavy, and that making decisions quickly and being able to react quickly, kind of like the point that you made, Deirdre, earlier, was taking too long because we had to reach out to too many places and too many people. Did you experience that?
Well, let me maybe start by saying that even though nobody could foresee what has happened in the last year, or a bit more than a year now with the coronavirus pandemic, we were prepared for negative scenarios. So we were able to turn our whole organization into working from home mode over the course of one weekend, basically. And that is still where we are today. Our number one priority is our investors and our associates. So we invested massively in making sure that our associates are safe in this working from home mode. We are now slowly but surely preparing to, indeed, as Deirdre has said also, to move to a hybrid model, because indeed that is what I see coming in the future, more flexibility, healthier, optimal life-work balance for our associates, and at the same time making sure that we keep the efficiency for the investors. Now, to your question, already before the pandemic, Capital Group being a global organization with 28 offices around the world, interactions through emails, telephone calls, video conferences were normal, absolutely normal. Oftentimes, we work hand in hand with people in other offices in Europe in particular. I'm thinking about places like Geneva and London, together with Luxembourg. Luxembourg has 4 branches also, so our Luxembourg company has 4 branches, one in Germany, one in the Netherlands, one in Spain, and one in Italy. So there also, the physical meetings were not happening all the time. Now, with the coronavirus, what has changed is the physical meetings were no longer possible. But it's not a big fundamental change. You also mentioned the interactions with service providers, and here I'm thinking, for example, the central administration, the depository, the distributors, and they're also, already before the pandemic, oftentimes these meetings were taking place over video conference. With all that said, I have to admit, I'm looking forward to a time, hopefully in the not too distant future, when the physical meetings will be possible again. Because with all the benefits of working from home and video conferences and the likes, I think sometimes physical meetings are more beneficial still. And in the future, we can have the best of both worlds, I think.
Yeah, exactly. Deirdre, did you notice anything from your perspective with clients in terms of, were they simplifying or asking for more reporting, or just to manage the changes that were going on?
Yeah, I think in the early weeks we saw an increase in the requirement for reporting, and then that settled down as we, I think as we established that the operational resiliency was there, that the processes were continuing as they were, that did settle and became a much more BAU quite quickly, actually. In terms of simplifying, I think there was, as we said or mentioned, that just things like e-signature, the ability to communicate and interact with different platforms and ways of accepting kind of instructions, that type of thing. That's what they were looking for as well.
Okay. Now, I mean, I guess we all realized that transformation anyway was at the top of everybody's agenda before the pandemic, so that wasn't new. But I think, at least from my experience when speaking to people, transformation was a nice to have, something we're looking towards. Let's take some time before we invest a lot of money. But of course, again, with everything that changed so quickly, do you think, or have you seen, Deirdre, at State Street or within the industry, that people have very quickly thrown themselves into transformation projects and more digitalization?
Yeah, I think, look, automation and transformation was always there. I think it was a key pillar within the industry. I think that the level of automation that existed was what helped the resiliency that we talked about at the start, and certainly helped to support the market volume and volatility. So I think the automation was there. There's already good levels of STP. There's always obviously room to try and get additional. I do think that what we saw was a move to look at processes that could be further digitized, using innovation to look at data flows and enhancing end-to-end connectivity on that. Particularly, kind of specific, honing in on specific processes. We're looking around the depository space and how we can digitize within there. So I think it did accelerate on existing projects that maybe would have taken longer to come to fruition. And this maybe comes back to that mindset question of quickly assessing business cases and driving those through quicker. I think it does cast the net as well a bit further and looking at, fintech solutions, looking at how we can incorporate those more and do it quite quickly within the systems. So I think, operational resiliency was definitely key, and that continues to be sort of a thought at the forefront for everyone.
Revel, you had the privilege of setting up a business right in the middle of a pandemic. Did that change your business plan in terms of automation at all?
Yeah, great question. I'll caveat it slightly. It was 6 months in advance, and this wasn't in our 5-year business plan. If it had been 6 months in the middle, I'm not sure we'd have set up. But no, I think we were very fortunate, and I like to say it was great planning and insight and foresight. But we decided to start with everybody, all partners. We call everyone partners. All partners having laptops and no desktops and no hardware. Everyone had iPhones. So we started with that, with a virtual client logins. And so whether we're in the office or at home, so like Jean-Marc, the following day we were all at home with our laptops. There was no real change. We were rather upset that we had this brand new office that we're not seeing anymore. But of course, in what we do, we have oversight of the industry. We work with many administrators like Deirdre at State Street, and credit. I mean, it's just an incredible story. How quickly, like State Street and others, adapted. We had stories where certain organisations had to equip staff with laptops, and within the space of a few weeks, had bought 600 laptops. One organisation equipping people in remote locations, offshore centres where the infrastructure, the local infrastructure, in the Far East, in certain places like India, where people needed remote access modems, so they'd equip people with home modems, and just remarkable story how quickly the industry adapted and the resilience. Yeah.
So the CSSF has put out a new circular now around teleworking, which is focused very much on the risks associated with it. Revel, in your opinion, is that going to be a big challenge for the industry, or is most of it common sense?
Yeah, common sense. You used the word I was going to... But I think a lot of it is common sense, and like Jean-Marc said, but what I think is... I see this as a really positive thing. It's just reinforcing what we do with common sense. There's a lot of practical things. The board is responsible. The board needs to approve policies and procedures. The lines of control, the 3 lines of defense have to ensure that they're adapting and monitoring. Of course, there's the security aspect, the increased security. So there's questions around private devices and knowing that that's a higher risk, and the dual factor authentication. There's only one area. So there's things like authenticating the person, identifying and authenticating the devices, identifying the location. And that comes back to something Deirdre was saying. We're seeing a lot more, digital signatures for boards, etc. Of course, there's a tax point. Where's the person? So people have to be more transparent and actually logging in the systems, noting where you are. He's not saying, I'm sitting in, I don't know, France, but you're actually down in the Bahamas signing, whatever it might be. But the one thing, and then there's the security components, monitoring that, devices, if there is data on home devices, that it's encrypted, that type of thing. The one area is connection times, and are those within working hours? That to me is odd, because we have flexible working, as I mentioned earlier. If someone wants to come in at 10 rather than at 8 to avoid the traffic, and they're in the physical environment doing that, why would we not allow them to do that in the virtual environment? So there are a couple of nuances that I think need to work through. But overall, I think it's a lot of common sense and a very positive thing to ensure we're all aligned. And ultimately, Jean-Marc said it, protecting investors, protecting our people, from hacking their personal devices, etc.
Yeah. I don't know, Deirdre, if you had some additional thoughts around the new circular from a administrator perspective, or similar concepts.
I think very similar thoughts, really. It's, largely kind of a lot of common sense, really, within it, and just a case of working through it and looking at, the governance models, etc., and the practicalities of ensuring, as Revel had mentioned, how do we ensure that we're able to track efficiently and not create an industry out of making, looking to see where people are actually working from and recording that. But yeah, largely all good
So
framework
if we
to
move
move
away
forward with.
if we move away from the operational aspects for a minute and think about the market, because there was also a big change in the market over the last year, and very positive changes, actually. We've seen a tremendous amount of growth. I mean, Nicolas mentioned some of it earlier. And also a great number of launching of products as well. So Catherine, could I ask you to maybe share with the audience a little bit some of the larger aspects or changes that have occurred in the last year and some of the popular products?
No, sure. But let me maybe before to start, so just putting things into context, to explain a bit the market developments and products that have gained attention lately. Just to go back at where we were at the beginning of the pandemic. So in terms of market situation, so fragmented asset management sector was clearly there, with a clear push for consolidation. Digitalization was mentioned, got center stage as foundation for new economy. Dry powder at 2.5 trillion, with a clear push for investments. At the same time, infrastructures and SMEs looking for private funding, and Nicolas mentioned CMU 2.0 was there. So, and then all this with the sustainable finance ESG agenda, which was pushed by both private and public sectors. So, and on top, augmented by the pandemic. All these elements, and also together with the very heavy EU regulatory agenda we are actually going through. And just to name a few, so ESA convergence of powers, the LTIF2, IFMD2, SFDR, have created huge opportunities, and despite all the obvious complication with around sourcing, diligencing real assets, especially during the pandemic. So we have seen funds being launched and raised actually faster than ever before, and with everyone extremely busy. I mean, we all know that. Yeah. So we have seen investors also shifting their priorities slightly, and I mean, they were not only looking at expected returns in financial terms, but we're also kind of considering what is the sustainable impact of the investments that they're making. So, and all this with the ESG push. So they're now looking at asset classes and products. So in terms of asset classes, that remain the generic PE, venture capital, very techy though. That's what we've seen, debt, infrastructure, and real estate, but they reacted obviously quite differently. So while PE, venture capital, debt, and infra, they went very well, still obviously with that ESG shift. They were seen very trendy. The real estate was, had different concerns, and obviously within real estate, logistic was having, we're seeing it differently than resi or office, obviously. So now, in terms of products, and I mean that's not only the pandemic and Brexit has played its role in there, but everything was very Eurocentric. AIFs coming in different shapes and forms. Then with Luxembourg clearly positioned as the main hub for alternative investment funds. And Nicolas mentioned 5 trillion of asset under management in Luxembourg. So Luxembourg indeed crafted its then position over the 30 years that were built. And I mean, if you look at the structuring toolbox, better than ever. I mean, with acronyms like UCITS, SICAR, LTIF, SCSP, RAFE in all directions. So, and then obviously with the 150 countries of distribution channel for Luxembourg, I mean, was just weirdly enough an amazing period for us. So
it was an amazing period, especially in the alternative space, as you mentioned. But one other area that has really taken off is ESG. And I guess this is not specific to Luxembourg, but we're talking about Luxembourg today. Jean-Marc, from your perspective, what are your thoughts on the ESG? Is that just because a reaction to a new regulation and everybody is now, starting their ESG funds because it's the trendy thing to do? Or do you think that's really something here to stay?
Before I answer that question in 1 minute, let me also echo what has been said before and what has been also largely covered in the press, is that the financial sector is doing well.
Yeah.
despite the pandemic,
Yeah.
even though that might sound counterintuitive. We have seen tremendous growth also in our organization. Now, to ESG, for me, this is not a temporary hype. This is something that is here to stay. I am convinced about this for two major reasons. The first one is very strong appetite and focus and importance that the investors put into ESG products. And the second one is also a strong push from the politicians in favor of giving more importance to ESG products. Now, what we did in our organization is we strengthened our teams of experts, and we started to engage more with companies in which we invest through our fully integrated investment management model. We have also implemented the SFDR, so the regulation you mentioned. We stand ready for the next phase. We took a prudent approach right now, but we stand ready for the next phase. And once again, I don't see this going away. On the contrary, I see this becoming even more important in the near future.
Yeah. Would you echo that, Revel, from what you're seeing from clients?
Two points you raised is, the government, and but I think there's a third is the youth. It's amazing how you listen to your children, and they're so aware. I mean, it's just, and they will invest one day. So it's the investors of today. But I 100% agree. This is not a fad or a trend, and it's a direction we're moving in, which has a hugely positive impact. And us as an industry can make that impact, whether it's on the environmental, whether it's on the social and modern slavery, and the governance and equality in terms of boards, pay. There's just so much good that there's no negatives in my mind. Of course, when you're ever going through a change, as humans often, we don't like change, and we don't like all the hassle of all the additional reporting, but that pain will pass. In a couple of years' time, this will be the norm. We'll do it. It'll all be automated. The data is difficult. I'm not oversimplifying. I know it's very complicated to get the data, but when it's done, it's for a great cause, and I firmly believe this is to stay. And back to what Jean-Marc was saying, the money will dictate behavior, and the money from the investors and where they're putting it will dictate the behaviors. Yeah.
Totally agree. So if we then switch to one other big change, and Nicolas mentioned this earlier as well, that happened in the last year was Brexit taking force, or being fully implemented, I should say. Catherine, what are some of the challenges or the things I guess asset managers, US asset managers who are listening to us should really be thinking about when they reflect on Brexit now?
Yeah, sure. So, and I try not to repeat in a bad way what Nicolas is saying, but no, clearly Brexit has had an impact. That's a given. And I mean, let's put it there. I mean, the UK was the natural entry point for the US managers willing to set up operations, raise capital, or invest in Europe. And I mean, simply put, that was the European gateway and for the asset management industry. Now, with the UK no longer being a member state, US managers have again actually been looking for other entry points, and with Luxembourg being the main asset management center within the EU, the focus has quickly shifted there, and that's a given and the reality of what we've seen. So now maybe just to put a bit more color to that. So you have two ways to access Europe, right? If you're looking at raising capital. So the first, the one that we all knew before IFMD, so national private placement regime, with the good, the bad, and the ugly, actually. It comes with limited access, so only relevant for those testing the water or looking at certain specific jurisdictions only. But this will, as I think that was mentioned before, in August we'll have the cross-border distribution directive, which will be implemented, and it's actually in 2 months. And I mean, that will be even more difficult for the private placement to be done. So that's also a reality. The second option then is boots on the ground. So for those who want to go further and for the extra mile, actually, all EU market can be accessed with the new passport. And, but that requires indeed more skin in the game, meaning that either your own AIFM or that of a third-party provider can offer you that passport and allow you to access Europe. I mean, obviously, so while the marketing passport opened all the EU member state doors, I mean, it still comes with certain operations. So not necessarily for everyone, but that's still largely recommended. And Luxembourg, here again, I mean, second worldwide place for investment funds after the US was again an obvious choice. So in other words, marketing funds in the EU comes with a few strings, as mentioned. Careful mapping and planning needs to be done, but just like any other passport, it needs to be carefully monitored in accordance with local rules. And also maybe, I think it's still relevant to be mentioned because the reality is still that some of our US managers do not necessarily raise capital in Europe and are simply investing in Europe. And so in that context, there is also a very relevant, important tax consideration to keep in mind. The investment context has changed quite drastically over the last years due to anti-abuse rules, which EU countries have introduced in the wake of the OECD BEPS project and the recent case law from the ECJ. So many of these rules, for instance, the main purpose test, which regulates access to tax treaties, and the general anti-abuse rules, are big picture tests, but looking at why an asset manager sets up a presence in a given country, investment structures where non-EU funds set up an SPV in an intermediate jurisdiction to get access to tax treaties or EU directive for a single deal with no other connection in that countries are simply vulnerable. And that's a given. So asset managers should therefore focus on establishing robust investment platform in one single country and not to deviate to that single country. So again, if they want to pass the chances of passing the anti-abuse challenges, then that's a very good thing to do. And setting up fund structures, mancos, and operations in that jurisdictions obviously further increases the chance.
Yeah.
Yeah.
I think that takes me perfectly into my next question around substance.
Yeah.
In any case, substance was sometimes quite complicated and dealing with multiple regulators and so forth. Revel, being a third-party management company, do you see a trend more in outsourcing that substance from asset managers?
That lines up for a great question for me, of course. But Serena, just to clarify, my co-founder Steve Bernard and I, we're very much pushing the third-party manco. You shouldn't set up your own. We're a governance solutions provider. So if someone wants to set up, we help them set up. So I'll just caveat that. Yes, what I would say is buying behavior is changing, and that's changing for a number of reasons. One, there's margin squeeze, the more passive, there's pressure on fees as we've seen. So, and I can't talk broadly about fees, but if I talk very broadly, 10 years ago, you could make 15, 20 basis points in a manco. I won't give the fees today, but it's definitely not that. It's 1/5 of that or whatever it is. But so, fee pressure is there. And so you've got to have the automation, you've got to have the economies of scale. And there's a lot of duplicity. And so, and on the other side, and I think it was a little bit Brexit related with ESMA trying to create, and has done very well, a level playing field. So there wasn't arbitrage, jurisdiction arbitrage. Come here and you can only set up with 2 people versus go to this jurisdiction and you needed 10. So what that has is up the bar for everyone. Everyone needs the 10 now, or whatever it is. But so I think you've got increased number of people, increased substance requirements, cost pressure coming down, and then this general acceptance over time. If you think the evolution of the funds industry 50 years ago, asset managers, fund managers did custody and admin. Then they gave up the custody. Then 40 years ago, they gave up their admin. Then what I did 10, 20 years ago at Bank of New York and Northern Trust, it was middle office outsourcing. That was the whole change. State Street did the first, I think, some of the first with PIMCO, then Bank of New York, then Northern, and that trend. But that's well established. Yeah. People at the time, the thought of it was a buying behavior. Why would I give up my investment record to a third party? So I think those things have all gone further and further up the chain, and now the governance piece. What I would say, just quickly, we've talked about some of the things, Brexit. What I've also seen for US firms, clearly there has been opportunity and increase. We see US Bank setting up. Gen2, a very large private capital provider, private equity administrator in the US, setting up. They're coming in here for a reason. And that reason, I think, is one, Nicholas mentioned, it's not directly Brexit. The industry is growing anyway, above 5 trillion. But a lot of US managers historically would have used London as their hub for their MiFID activity, marketing, distribution, and the portfolio management, which will stay. And the other is the AIFM. And that now that AIFM management passport's gone, people are realizing you can't rely on private placement and reverse solicitation. And the MiFID activity, you can't sell, and are these models for tied agent. I think people are setting up, saying, this is what's core. Portfolio management, distribution, and how can I still access Europe? Yeah. So certainly there's been a lot of growth.
Yeah. And now you gave us the perspective of an outsourcing. Jean-Marc, of course, Capital is elected to have a local management company. What were some of the considerations when deciding to go local?
Yes, indeed. Let me start by saying that we are here since 52 years. So 2 years ago, we celebrated 50 years of presence in Luxembourg. Today, we have a very strong team also in terms of headcounts, and all the different areas are covered by our experts in Luxembourg and through the 4 branches, even though the branches are used mainly for marketing and distribution purposes. So what has brought us to Luxembourg was, and some of these points have been mentioned and made by Nicolas already in his introduction, so indeed the unique international ecosystem and the approach, also together with the knowledge and know-how and broad spectrum of experts in finance that you find here in Luxembourg. Of course, it was not always like that back in 1969, but the international aspect was already there, and the cross-border specialization in Luxembourg. Another point that we value enormously is a stable framework in an open Europe. And then one point that I would definitely add that has not yet been made, that is a regular and constructive dialogue with all stakeholders, whether it's the investors, the trade associations, but also the decision takers, the politicians, and the peers. And I think that is a unique environment you find here in Luxembourg. And I would finish by mentioning really also competitive conditions. Let me give you one example. When the umbrella fund concept was introduced in Europe, it came from the US originally. Luxembourg was among the first countries to accept these structures and find a way to make them work, because the Luxembourg regulator at the time already realized the benefits for the investors. So that is just one example where Luxembourg has played a pioneering and innovative role. We still see that today in other fields, whether it's digitalization, fintech, regtech, or smart contracts, just to name those.
So I'm really conscious of time and the fact that we've gone over. But if I could just end the panel, and I really appreciate everyone's thoughts. And like I said, a nice mixture of different perspectives from the different service providers or parties within the asset management industry. But as a final question to leave for our US asset managers out there and participants out there, what is the biggest, in your view, the biggest change or the biggest new norm that needs to be considered by anyone who wants to enter the European market?
I would really say in one sentence, and we already touched upon the subject, it's the weight and the importance of sustainable economic activity, sustainable finance. And here comes the tricky part, combining that one with decent returns, because we know at the end of the day, that's what investors still want. So it's the weight and the importance of ESG and sustainable finance combined with decent returns.
Okay, Catherine?
I can only concur to that. So that's definitely the biggest change. But I mean, I think looking at Brexit and etc., everything I mentioned, I think having strong operation here is also a relevant advice, I think.
Revel?
to be slightly different, then I think continued improved governance through better information, more transparency for investors, driven by greater technology innovation, and it's driven by being remote working, teleworking, and the environment we're in.
Perfect. And Deirdre, yours.
Yeah, I'm going to agree with all of those and sort of combine them. I think ESG is definitely top of the agenda. It's key, and I think probably the technology solutions and data solutions to that as well.
Perfect. So thank you very much, everyone, for your attention. I leave you now in the good hands of Keith O'Donnell, who will be covering some recent upcoming developments in the EU around the tax environment specifically. Thank you.
Hello, everybody, and welcome. Gives me great pleasure to see you all here. Hundreds of you, I'm told. I have a very active imagination, so I can actually imagine hundreds of you out there smiling and looking very interested. So if you're sitting at home behind your camera, please smile. If you don't, we'll be watching. So I'm going to talk to you about recent developments in tax matters in the European Union. And I kind of got tired of saying this over the last few years, but it's been a really interesting time to be a tax advisor over the last few years because the pace of change has been frenetic. And each time we think we've reached peak change, something else comes behind it. I was talking today to a representative of one of the EU member states, and we were having a discussion about country-by-country reporting. I'll come back to this afterwards. And I said, well, what do you make of what's just come out in the latest European Commission communication? I'll come back to that as well. And he said, frankly, this is my responsibility within the ministry. I haven't a chance to read this thing yet. He said, I just can't keep up with this. And I had a lot of sympathy with him because that's the way we all feel at times. So I thought before diving into it, it might be helpful just to briefly run through what the EU tax framework really is, because sometimes it can be a little bewildering seen from the outside. And I thought, since this is an American theme, and for our many American participants, I might try to do it in a way that's comparing it to the US. So starting point is the European Union is a union of national states. So it's not federal states, it's national states. It's pulled together by an overarching document, which is the EU Treaty, which is like the which is like the American Constitution in many ways. So although we all as member states have national sovereignty, ultimately this document, the EU Treaty, has primacy over our laws. So our laws have to respect that EU Treaty. And we'll come back to afterwards why that's been quite important recently. So within the European Union, the kind of hierarchy, you could look at it as, first of all, there's the member states, sovereign nations, and they act together through a council, which is the representatives, typically the ministers of those states. Then you have the Commission, which is a type of hybrid. There's no exact US equivalent. So it's a mixture between a permanent civil service and an executive with limited executive powers. We don't have the equivalent of a president. We don't have the equivalent of an executive. In third, you'd find probably the European Parliament. The European Parliament is significantly different from the US Congress in that it has very often a more consultative power, a power to decide, but basically most pieces of legislation are proposed by the Commission, approved by the member states acting in council, and then the Parliament has their say in the process. And then finally there's the European Court, which is to some extent like the Supreme Court. They're the ultimate arbiter of European law. And that's interesting because the European Court has shown tremendous autonomy in holding the member states to account sometimes when they seek to do things in tax matters that would discriminate against certain categories of investors. The European Court will sit there quite firmly and say, no, you can't do this, give them their money back. And I'll come back to that as well. So what's been going on in the EU? I'd like to focus maybe first of all on some investor protection matters which have evolved over the last 12 months, which have been quite interesting. So the EU has a series of principles designed to strengthen the capital markets within Europe. And sometimes the results of these have been quite surprising, both to investors, but also to the European member states, frankly. And to give an example, last summer, our firm has been litigating actively on behalf of US investment funds all around Europe. And basically, we are trying to reclaim money that was unduly withheld. Why do we say it was unduly withheld? It was because European member states gave withholding tax exemptions to their domestic funds, but didn't give them to, in this case, American funds, typically registered investment companies. And the European Treaty says you cannot discriminate against investors who would be otherwise in the same position. And consequently, we took a series of lawsuits, and there was an almost comical scene over August when suddenly one of the large states who had lost some of these cases but was kind of refusing to pay out, this was France, suddenly decided over the month of August to start paying out hundreds of millions, and they wanted to pay them out very fast. Because I think they decided, once they decided to pay them out, they had an interest clock which was ticking, which was costing them potentially millions a day. So suddenly we had this mad scramble over the month of August, telling some large US investment houses, tell us what bank account this money is going to go into, because there's a French civil servant about to hit a button on something and wire you 100 million plus. So it was a kind of an interesting situation to have. You could say a very good problem. But I think it illustrated a number of points about investor protection in the EU. First of all, you have this principle that you can't be discriminated against. And in a lot of cases that applies on a European basis. So a state can't discriminate, for example, against a Luxembourg fund investing into France or Italy. But in many cases, it also applies to non-European investors, which creates a very stable and investor-friendly environment. So another area where there were some very interesting developments is, and this is literally in the last couple of weeks, the European Court made decisions in a couple of cases that are called state aid. And what is state aid? State aid is a concept that says when member states exercise their sovereignty in tax matters, they have to do it in a way that respects the European Treaty. So back to this idea of the European Treaty being a sovereign document. And they can't give tax breaks, if you like, in a way that's considered to be a distortion of competition. So typically awarding a tax break to a particular sector or a particular taxpayer. So many of you will have seen that the European Commission quite aggressively litigated some of these cases. And initially they were mainly aimed at US companies, very often in the tech sector. So there was Apple, there was Amazon, there was Starbucks. And at some point people started saying, is this an American thing? So then conveniently they produced some European companies and started litigating those as well. But what's been interesting in this case is two things, I guess. First of all, again, we've seen the limits on member state authority. But secondly, we've also seen the court prepared to take quite a hard line. And in this case, in most of these cases, it found against the Commission, and it said what the states were doing in their tax laws was actually consistent with the European Treaty. So while you, the Commission, may feel that Apple should pay 13 billion of extra taxes plus interest, we actually think you're wrong. We don't think this is illegal state aid. So ultimately, that situation was protected, which I think again illustrates this point of we have a court that's prepared to stand up to member states and the Commission and say, no, if legally you're wrong, and too bad for the money. The cases last week, interestingly enough, the Amazon one was won by the taxpayer, and there was another one called Engie, which was lost by the taxpayer, and the states which generally litigate with the taxpayer. These will be appealed, so we'll have to see how they proceed over time. But again, they show this protection of investors and this way that the court is prepared to say, you have to respect the law even if you don't like it. And this is one of the reasons, if you like, why Luxembourg has been, I think, also successful as an investment jurisdiction. Because ultimately, a Luxembourg investment fund, when it invests in another country, benefits from the same treatment as the local funds. So if a France or an Italy decides to give a particular tax advantage to a domestic fund, it has to be prepared to give the same one to a Luxembourg fund. So a Luxembourg fund investing on a pan-European basis, for example, in alternatives, may choose to take advantage of French tax advantages for French alternative funds, Italian advantages for Italian funds because, again, Italy and France can't discriminate against that Luxembourg fund. So you can build pan-European strategies that take advantage of domestic tax rules because you can't discriminate. So that's a whole area of around investor protection and this idea of the courts acting to protect investors. And it's been very, as I said, active over the last 12 months. So what other tax developments have there been that could interest you as investors? First of all, there's been a whole implementation throughout Europe of what's called the BEPS package, base erosion and profit shifting. It was an OECD series of measures which the EU implemented quite vigorously, shall we say, and was quite far ahead internationally. When the EU implements tax legislation, it generally does it in the form of a directive, which is an instruction to the member states to implement national law, because member states are sovereign in tax matters, and therefore they have to implement the law. It's not a central European law. And Luxembourg was quite in advance in implementing a lot of these. So you have a package called ATAD 1 and ATAD 2, Anti-Tax Avoidance Directive 1, and logically enough, Anti-Tax Avoidance Directive number 2. These were basically all dealing with corporate tax. So from an investor perspective, generally they would only affect the companies you invest in. However, they did have an impact on investors, and if you're an investor, for example, a pension fund investing in an alternative fund in Europe, you might have been asked, please confirm how you treat this entity from a US tax perspective. And the reason why that was, and it led to some quite complex discussions, was that it can impact what's called the anti-hybrid rules in Europe when a European company seeks to deduct interest, for example, that ultimately flows up to a US pension fund. So while I think it probably didn't change investment returns, it did lead to some quite complicated discussions at times to explain why are we being asked these questions. In the same order, there was another directive. This one was called, we like acronyms, DAC 6, which is Directive on Administrative Cooperation number 6. And in case you're wondering, there was a 1 to 5 before it. And DAC 6 involves the reporting of what are called cross-border arrangements. And the idea is basically something in the US that's called tax shelter legislation, whereby if you do something that's a tax shelter, you have to report it. Now, in this case, although it was based on BEPS recommendations, the EU probably went slightly overboard, and we decided we should disclose everything that was potentially aggressive from a tax perspective and that was cross-border. Coming back to what I said before, member states have the power to implement this themselves, and they implement it slightly differently. There was a diversity in how this was implemented. So some member states, for example, took a very broad view of what a potentially aggressive tax scheme could be. So, for example, we had to look at whether simply investing in an investment fund became a reportable transaction. Now, on the face of it, something being a reportable transaction isn't a big deal because the information goes to a tax authority, life goes on, basically. It could be the basis for them to investigate something, but most of these structures are very plain vanilla. Where it created issues at times was some investors said, well, if this is about reporting something that's potentially aggressive from a tax perspective, we don't want to be in that. And that got quite complicated when we had to explain sometimes to investors, even though this isn't actually aggressive, because of the way that a member state has implemented this into law, it captures everything. So it's going to be reported. So although you may have something in your tax charter that says we don't want to invest in anything that's aggressive from a tax perspective, you may just end up having a reporting because an investment fund was used. And this is unfortunate. The cases are minor. But if you wonder why sometimes you get strange things to sign in your fund documentation, this may be the reason why. So these are all European implementations of historic OECD measures. Now, what about the new ones that are coming up? Basically, there's a package of measures now coming through the OECD, and they're called Pillar 1 and Pillar 2. And again, they're principally aimed at corporate tax. Pillar 1 was originally aimed at the digital sector, but I think helpfully it's been broadened into a larger discussion and a larger proposal around taxing different parts of corporate profits in different states. And it's typically aiming at a situation where a big multinational enterprise may book a lot of revenue in a country, but doesn't have any presence there. So under the existing rules, it wouldn't pay any tax on its profits there. And particularly for big multinationals, it was felt that this was unfair because some countries where there were large markets weren't seeing any tax. So as a result, we're having something called a Pillar 1 proposal, which will probably aim at a handful of very large multinationals. And for example, the number of 100 worldwide has been bandied around, which will have to calculate their profits globally and allocate some of them to states where they may not have a taxable presence. So it'll be quite a heavy administrative burden. It probably won't, if you're looking at it as an investor, change your tax bill that much. There were some concerns in the asset management industry that investment management companies could get sucked into this. I think nowadays it's unlikely. As an industry, we did try to point out that although the industry is quite virtual, there are reasons it's organised the way it is. And if there isn't a regulatory presence, it seems a little bit silly to say there's a tax presence. So hopefully it'll be more something that hits portfolio companies rather than funds, certainly, and probably not investment managers themselves. Pillar 2 is a slightly different one. Pillar 2 basically aims to establish minimum tax rates. And this has made a lot of progress with the new Biden administration, because all of a sudden the Biden administration is saying, well, maybe we think there should be a minimum tax rate as well. And this fits very well with the Pillar 2 proposals. So I think if the US and the EU are behind these proposals, they probably will advance, and they will advance fairly quickly. Where Luxembourg will sit on this is, I think Luxembourg's view has always been, we are all in favour of global initiatives. What we want to do is avoid national initiatives that basically do things on a piecemeal basis and that potentially create trade wars. And unfortunately, one of the developments in the EU is less positive, and this came back partly again in the paper that came out on Tuesday. One of the things in there was saying that the EU would like to collect what it's calling a digital levy. So it's kind of a tax on digital activities, and it's to feed EU resources. EU-owned resources are basically designed to pay for the 750 billion pandemic recovery plan that's been funded through a central budget, which was quite new in European terms, since generally the central budgets were not designed for that. At the moment, the EU Commission's paper says they still want to collect this levy. Personally, I think it's going to be a stretch, because I think it conflicts with the new vision of Pillar 1. But that's, I'd say, relatively minor. What was even worse, and this is kind of almost like a three ugly sisters thing, the second one was something, there's a principle called country-by-country reporting, which was proposed 10 years ago. It's a kind of formal reapportionment of profits. Nobody really was that interested. The member states saw it as an attack on their sovereignty. They weren't that interested. It wasn't really solving any problems. And now it's back. And I think maybe inspiring itself from the US. What used to be called CCCTB, which is a mouthful and not terribly appealing, is now being rebranded as BFIT, which sounds like an aerobics class or something. I mean, it sounds quite appealing. But basically, it's just the same idea. It's just been rebranded. So personally, I think it's not a great idea. I think there will be some resistance from member states, but it's been put into this Commission communication, and they are hoping to push it quite aggressively. In the list of not so good proposals, I think we may also see over the next months what's called country-by-country reporting, but in a public format, which basically requires the publication of multinationals' profits and taxes paid in a number of countries. This information is already available freely to tax authorities, so they should be able to do whatever's necessary with it. This is the idea that it should be made available to the public, so that they can judge in some way multinationals in a way other than tax authorities do. I personally think it's a bit populist. I think it's a bit unfortunate. I think there's some real issues with it, because there's confidentiality issues, there's competitiveness issues, and I think there's also some international trade issues if you try to force non-European companies to publish this information as well. But unfortunately, it's still there. And then finally, following the three ugly sisters, there's one last thing I think that reappeared again, and this in cinema terms, I think one of the previous speakers was talking about the good, the bad and the ugly. This is the zombie of the European tax world. This is the one that just won't die. It's the financial transaction tax. And in this European Commission paper, which had lots of really good and interesting things in it, like the percentage of taxes paid by labour, capital, environment, really good stuff. And then somewhere in there, they just put in again, and how about the financial transaction tax? As I said, it's a bit like the zombie that just keeps coming back, it won't die. I dearly hope that we won't implement it on a European level. But again, if there's a European decision to do it, I think generally Luxembourg, within reason, will follow ideas. So far, Luxembourg and a number of other member states have pushed back strongly. I think that'll continue, but it's out there on the horizon. If you hear about it, it might be there, it might not. We'll have to see. So I'm conscious of time ticking on, and as you've gathered, I talk a lot and enthusiastically about tax, but I'd like to try and wrap this up in a way. And I think what we've seen, as I said, is a lot of change. It's always slightly disruptive, but I think generally it's positive. I think it's moving us towards a healthier tax environment. I think Luxembourg's part in this has been to exercise its sovereignty in two ways. One, to try and influence European tax policy in a business-friendly way, because we are a business-friendly jurisdiction. And secondly, when it comes to implementing directives, is to try and implement them again in a business-friendly way, respecting the directive, what we're meant to do, but not trying to go overboard. And I think combining those two things and the fact that Luxembourg benefits from this protection against discrimination within an EU context, I think it should create favourable conditions for international investors, both investing in Europe generally, but also, and that's the theme of this to some extent, using Luxembourg as an investment platform to do that. So with that, thank you for your attention, and I'll wave at you and hopefully you'll wave back at your screens, and I look forward to carrying on the discussion. Thank you.
Hello, it's fantastic to be here. My name is Nasser Zubairi. I am the CEO of the Luxembourg House of Financial Technologies. We are going to be talking all things fintech in Luxembourg and a little bit more around the EU. I'm very happy to have with me two distinguished guests from the Luxembourg fintech ecosystem, Bert Boemens, CEO of Governance.com, and Olivier Portensegni, who's the CEO of Funds DLT. Welcome to both of you. Thank you for being here.
Thank you.
Thank you, Nazim.
So guys, if I may say, you are both not Luxembourgers by birth. You are both working and living in Luxembourg, I think, for a number of years. I mean, Luxembourg as a community revolves around a multitude of foreigners living and working and helping to grow the economy. How do you both see the benefits, or how have you seen the fintech sector in Luxembourg develop with your sort of eyes as a foreigner on it? How's it changed? Bert, why don't you tell us?
Well, the development has been enormous. It's almost comparable with the development of the real estate in Luxembourg. If you look 5 years ago, you don't recognize the country anymore, and I think it's a little bit the same with the fintech ecosystem. If you look back 5 years, so we with governance we've been in business for 7 years, and so but just 5 years ago, I think the industry of the industry interest in fintech was mostly abstract. People were interested to find out what was happening there, but not a lot of people were actually doing something. You probably you recognize it as well. Now, whatever was happening and where there was a little bit of adoption was on robo-advisors, on digital wallets, on a little bit of DLT as well, but very much on the consumer-facing side of fintech. I think what the shift that we have seen in the last couple of years is that now also the institutional side is really catching up. There's a lot of development in fintech, in digitalization in financial institutions. So it's a day and night shift, but that's happened, I think, mostly over the last 2 years. Now, Luxembourg, of course, has been building this ecosystem for 5 years, and it's actually good that we started so early. Maybe 5 years ago you might have considered that it was too early. The market wasn't ready for you, but it's sometimes better to be too early in the market so that when the wave comes that you can actually catch it, and I think that's what we're experiencing now.
Yeah. And Olivier, how have you seen it being developed over the past 5 or 6 years?
No, certainly I would concur with Bert. I mean, we see a fintech ecosystem in Luxembourg booming to a certain extent. even if I think the kicking point and the starting point was more related to the crisis in 2007 and 2008 than the COVID-19 situation. But it took time for the actors basically to realize that more than building just only mobile app, they need more profound transformation of their infrastructure. And that's where you see a lot of emergence, as you said, around KYC solutions, digital wallet, crypto exchanges. You see as well the emergence of D2C, much more oriented business models, which is very interesting for, especially in the asset management industry. And indeed, these asset managers, but also the wealth managers had to rethink profoundly their operating model and transformation, and because they are under huge pressure from an economic but also competition. I mean, ETF and passive investment is a good example. So nowadays we see more and more institutions collaborating with fintech. Which is very good for us, obviously, and interesting. And certainly because they see, if you look at a bank typically, or even an asset manager, you can slice and dice them into different pieces, and you can find a fintech that is even better on one of these pieces. And I think the key winning point for these actors will be integration of multiple offerings from different fintechs. Hence the reason why I see certainly fintechs booming for the time being, especially in Luxembourg.
Yeah, I mean, we now estimate there's probably between 250 to 280 fintechs that call Luxembourg their home, generating way over 500 million in revenues. Now, maybe to our US friends watching, that may not sound like a huge number, but I think we need to put into context the size of the country and the accessibility to the stakeholders, particularly in the institutional segment. And I think, you know, there are a multitude of reasons why people have chosen to come to Luxembourg or to call Luxembourg home for their fintech businesses. But why do you think, and maybe your own story in itself, why is Luxembourg an attractive center for fintech? Why has it blossomed in the way it's blossomed, Bert?
Well, I mean, the standard answer is if you want to build a business, you're looking for a place which has a stable political system, good growing economy, things like that. And of course, we have all that stuff here. But I mean, if anybody has read the Entrepreneur Roller Coaster, so Darren Hardy that wrote that book, he said your number one job as an entrepreneur is selling. And for selling, you need clients. And so it depends a little bit what sector you're in, but if you look at the asset management sector that we play in, I mean, Luxembourg is the second biggest fund domicile in the world after a small country called the United States. But what is more interesting for me is that it's the biggest cross-border fund distribution center in the world. And that means that as a fintech, as we operate with local players here in Luxembourg, we automatically get access to all the markets that they operate in as well. So you want to be really at the core of where it's happening. And as the clients are successful and expanding as well, we can automatically expand with them as well. So for me, that is the main reason to be here in Luxembourg, to be very close to our clients, and of course to have accessibility to decision makers.
Yep. Olivier, would you concur?
Yeah, no, so I mean, if we look at why we set up in Luxembourg, probably our situation is a bit different, as you can imagine. Yeah. Because first of all, we were incubated and we are active in the asset management and fund distribution more precisely. So we were incubated into the Luxembourg Stock Exchange and FundSquare as its subsidiary. So naturally, we set up in Luxembourg, but where I would certainly echo what you were saying, Bert, is, I mean, the client base was very important for us. I mean, as we are active in asset management and fund distribution, I mean, we have a very large client base in Luxembourg, even if sometimes the headquarters is somewhere else. But it gives you access basically to all the European countries. And also from a skill set perspective, asset servicing is very predominant in Luxembourg for funds. And we access a number of skill sets from that perspective, from business skill sets as opposed to IT. That we can tap in pretty easily because we have a huge experience in Luxembourg on asset servicing. So certainly that was multiple reasons. Also because we are very tech-oriented. I mean, Luxembourg, we claim to be number one in terms of ICT infrastructure. That helps a lot as well to access this type of infrastructure.
Well, if I may just ask, you talked about the business skill sets. Would you also say, both of you, from a talent perspective, given that you are both servicing this sector, do you find it being here makes the talent more accessible for you to hire and to build your companies?
Oh, certainly, definitely. Again, I mean, even if we are fintech, business, building new operating model, we need people that understand the business and how it runs today. So certainly having access to talent, even very experienced people, that helps a lot.
Yeah, I agree. I mean, it's sometimes misunderstood that most financial institutions and people working at those institutions, they don't actually care about the technology. They just care what it enables them to do. And what it enables them to do requires business knowledge. So I fully agree with that. And there's a big pool of talent for that.
If I may add, I must confess that for me, who is a complete sort of dilettante with any sort of language, the fact that I sit in the heart of Europe and speak English and have lived here for 5 years makes a big difference. I mean, finance, the language is still very much English. But then the skill set in languages as well, to be able to deal with the rest of the European Union. But I mean, now Chinese, I mean, there's so many people that speak Chinese here to be able to do business with China. Lux Stock Exchange, obviously, your sort of mother company, has a great skill set there as well. Yeah. So, yeah, it's the international sort of skill set in many ways, right? You talked earlier about sort of when things really jumped and kicked. Bert, you said sort of 2 years or so. You talked maybe a little bit earlier. But talk me through what you've seen as some of the key milestones over the past few years. What have been sort of the big flag events that have really led to leaps forward in terms of fintech and adoption within Luxembourg's ecosystem?
Yeah, but it's about alignment of planet, to be frank, and I think the alignment of, I mean, customer behavior, regulation, technology, all this make basically a key moment for fintech to emerge and to boom. If you look at ourselves a bit selfishly, I mean, we are active on blockchain, fund distribution, so there were many regulations, first of all, that favor the emergence and the adoption of this type of technology in asset management, in fund distribution, even in banking. And Luxembourg was certainly a pioneer as well there. But also, so this alignment of elements was key. The understanding as well of the technology. Blockchain, I mean, it was very much assimilated to Bitcoin in the past years. Nowadays, if I look at the conversation we are having with clients, we spend probably 2 or 3 minutes on blockchain and the rest of the meeting on use cases, which is a very good news because we move to a different level than in the past years where we were to explain blockchain, how it works, the privacy, the performance, blah, blah, blah. So much more focus on business. And for me, the real difference now compared to 3-4 years is the adoption. We are moving from prototyping to adoption now.
Yeah, but aside from winning the Luxembourg FinTech Awards 4 years ago, I remember that very fondly. What have been other key milestones in your journey and in the ecosystem's journey?
For me, I mean, the main milestones, and I think it depends on what part of the fintech ecosystem you're in and what part of the financial sector you're in. So for your use case, it might have made sense to start the discussions earlier. For what we do, process automation, we saw that really starting to move very much in 2019. It took a couple of years for the ecosystem to build, for people to get comfortable about it, and saying, okay, can we work with these kind of companies? But for me, the big catalyst that we have right now is the COVID crisis, because if it's proved one thing is that yes, you can change, and you can change very quickly. And so whatever people there were that were resisting change and saying we like the end result of automation, of fintech, of all kind of new technologies, but we're afraid of the journey to get there. And what people find now is that the journey is actually much shorter than they think. And so I recently read a study that said that 39% of financial institutions right now are actively prioritizing investment in fintech. And for me, that's a perfect example of saying it's very much on the top of the agenda of financial institutions right now.
Yeah. If I look at our case, I mean, to come from that same angle, I mean, another element that triggered as well the adoption is not only the COVID-19 situation, but also other phenomenon like, I mean, the Amazonization of products, where, I mean, incumbents or asset managers realize that data is king, basically to provide hyper-personalization of services. But in order to leverage on data, you need to rethink completely your infrastructure. Hence the reason why we see a lot of movement on more profound, I would say, transformation, more than just on the front-end layer, so the customer-facing aspect.
Yeah. Bert, you mentioned with COVID-19, I mean, to some degree, there was this sudden appreciation that technology is critical to business continuity as well, and to have a good infrastructure was so key. Would you also say that maybe, let's talk specifically the investment fund area, do you begin to see that some firms are seeing technology potentially as a competitive advantage, say with better processing, with using better tools as well?
Yeah, of course. I mean, asset management that we're talking about, it's a marginal business, very small margins, very big risks. So one major incident can wipe out years of profit. So you need to be extremely well organized. And what more and more financial institutions are starting to realize is that that is the competitive advantage, because in a field which is rather commoditized, a fund administration does the same thing as another fund administrator, but the one that can do it more efficiently and quicker is going to be the one that gets the client. And then on top of that, if you can do that more profitably by lowering your cost at the same top line, then of course it makes a huge impact.
Yeah. Olivier?
But also, I mean, technology enables as well to get access easier to the end customer, which was very difficult in the past and with traditional or old-fashioned type of technologies. So certainly, I mean, getting access to this customer gets you access to the data, gets you access to new product, new services, etc. So it's opening up a brand new world. So I think that's I mean, which was not possible if you were asking Revolut typically to do onboarding of 10,000 customers per day on 10 years old technology. Yeah. That wouldn't work.
No problem. I mean, you just said it's opening up a new sort of era of opportunities. Where do you think we're going with all of this technology? And maybe talk a little bit, I mean, given that Luxembourg is a hub for the EU, which is also critical, you know, we're not just, we have the great institutions here, but also from a B2C perspective, we've got a market of, you know, 500 million consumers as well out there. What opportunities do you see coming, let's say, across the EU, and what do you see as some of the challenges, Bert?
Well, if you look at the fintech ecosystem, I think the collaboration between the fintechs is very important. So what fintechs typically do is they do one thing really, really well, but they don't try to do everything. But they're built in a way where it's completely open architecture and highly modular. So you can connect a digital signature tool with an EID tool, with a KYC tool. And so, and for that, it's not just in Luxembourg, but across Europe. And I mean, it's an open market for us. We can connect with any company in Europe to do that, to find really solutions that make sense for our clients. So that connectivity is really important. I think one thing that sometimes people say a little bit about Europe is it's a fragmented market because you have national legislation and that makes it difficult. But it's actually, if you get really into it, it's not so dissimilar because most of the national...
The US has state-level regulation as well.
Yeah, and most of the national legislation is based on EU directives. So it's different nationally, but it's highly similar. So that means that whatever business model you build in country, and what we're doing here in Luxembourg, for example, is highly transportable to any of the 27 countries around you. And that is the big opportunity for fintechs to grow, but also for the industry to pick and choose, saying, okay, I want that solution from Luxembourg, I want that one from France, and I bolt them together and I have something that works for me.
Olivier, although blockchain has been a buzzword for quite a few years now, I think you are one of the core mainstream systems that has gained a degree of acceptance within this world. I mean, there are a lot of blockchain solutions, tokenization, we talk about a lot. but getting adoption is a tricky one. And you've managed to do this. You've done proof of concepts now and tests on your system, and the ball seems to be rolling. How do you see that market growing? I mean, do you see the opportunity for blockchain tokenization, etc., just accelerating throughout the EU and in Luxembourg?
Definitely, I mean, and certainly on two aspects. One is the B2C aspect and the B2B2C aspect, so helping both intermediaries but also asset managers operating on the same platform. So, and again, the whole holy grail of all this is getting access to the end customer more easily, more transparently, and cheaper. The whole idea is to get knowledge of this customer. If I paraphrase one of the main asset managers that I know pretty well, I mean, they are serving millions of customers today, not knowing who they are. So that's one opportunity, is to better understand them and, of course, better serve them. The other aspect is that if you look at Europe, I mean, only maybe between 10 and 15% of households are invested into funds. So, and fintechs are growing with their clients. So if our clients are growing from that perspective, we will grow as well. And we can help them tapping into that missed opportunities, because pension scheme will change in the near future. The old schemes where the younger generation pay for the older will change. So we will have to save much more privately. And funds, we hope, will be the investment vehicle or the preferred investment vehicle. And that's where typically we can help with our solution, blockchain solution, to tap in that market.
I think it's a very exciting sector, and you know, we can only see an accelerated growth, or hopefully a hugely accelerated growth within a sector like Luxembourg around tokens and blockchain. So it's fantastic that you've managed to penetrate through that barrier there with Funds DLT. Maybe just to finish off then, and to summarize, how, I mean, critically, obviously, you both work in a B2B segment. We talked a little bit and touched on the collaboration with the traditional institutions. How open are they now? Do you see much more enthusiasm for collaboration? Processes have improved? And then maybe also, do you think that the consumers in Europe, as sometimes people get this sense that European consumers are a bit more traditional in their approach. Do you also see or have any comments on how they've changed their approach to technologies, Bert?
Well, I think on the consumer side, I mean, we passed that station. I think more than 90% of people below the age of 65 prefer to do their finances online. So that basically proves that the consumer is already there. The institutions are somewhat behind, but they're catching up rapidly. I think right now, if you see the reluctance for some financial institutions, by the way, are much more educated than they were years ago. A lot of these companies have think tanks and committees working inside to identify technology as well. But I think they don't have so much a problem anymore with the technology, because they understand the technology now. They have more problem with the early stage of the company that they're interfacing with. So you might have the best solution, but am I, Mr. Big Financial Institution, going to work with you, a very small startup, for example? And that is, I think, a bigger challenge for fintech companies than the technology angle right now, which is a good thing to have, because one thing you can work on is raising capital, for example, but if the industry is not ready, that's very hard to beat.
Yeah. Olivier, have you seen a change in adoption attitudes from the institutions as well?
Definitely, because they become, even if they are still dragging, more customer-centric. And they should be less focused on their internal problem and focus more on their customer. And even if we are, I think, all behaving as fintech in a B2B world where we are serving institutional clients, at least if I look at our company, the only thing we are serving is their customer. So we help them basically serve better their customer as opposed to just themselves and increase their margin. We want to have the benefit passing to the end customer. So that's really, for me, the change that is going on today. That's not easy because, again, the transformation is very profound, but we are getting there. And again, I mean, it's more than just a mobile app.
Yeah. No, much more these days, indeed. Gentlemen, time is up. Unfortunately, we could talk about this endlessly. Bert, thank you very much. Olivier, thank you very much for your words. Thank you all for listening to us. Up next, we have Thibaut de Bassy from the European Payments Association giving you a presentation on payments within the European Union. Thank you very much.
Ladies and gentlemen, I'm Thibaut de Bassy of the Emerging Payment Association. We are a business club of decision makers in the payment industry. Now, let me talk to you today about e-commerce and the payment scene in Europe. First of all, let's look at the total e-commerce market in the world. It's about $5 trillion US. The leader is China with 2.7 trillion. But right after that, we have the US with about 800 billion, and Europe. If you combine all the European countries together, what you have to remember is that the size of the market is comparable to the one of the US. Now, I will spare you the obvious. With COVID, people have flocked to internet, which has driven e-commerce, which has driven electronic payments. We have probably gained about 5 years in the shifting process. Now, a key point when you look at the top 5 marketplaces, the most successful merchants in Europe, you will be happy to see that we have 2 US champions there. Amazon, by the way, with its headquarters in Luxembourg, and Apple. But all the others are local champions in their own country, Germany, UK, France, etc. So it becomes pretty local. And if you want to be successful in e-commerce, you have to understand how people want to pay. Cultural centricity blinds us to the differences in purchasing habit. So without carefully considering the data, companies may default to whatever payments methods have been working domestically. Now, just to set the scene, let me show you what is the market share of the different payments in the US, and then we will go to Europe. Now, ladies and gentlemen, you will not be surprised that in the US, credit card is number 1. Then we have digital and mobile wallets, such as PayPal or Apple Pay. Then debit card is behind, and buy now, pay later is just emerging. Now let's have a look at Europe. Well, in Europe, digital and mobile wallets occupy the top position. Debit cards are about the same market share than credit cards. And you can see that buy now, pay later already has a significant market share. Now, you might say that behind a digital wallet, well, there may be a credit card, but this is less and less true. Many European digital wallets are based on current accounts and are based on the instant payment rail. And why is that? Well, there are two big reasons. The first one is cultural, is that in Europe there is some aversion to credit, especially in the northern part of Europe. But the second reason is technological. It's because account-to-account transfers in Europe are more and more instant. Why? Because most of the banks are offering instant payments to their retail clients, sometimes at an additional cost, but more and more free of charge or included in a basic financial bank package. And the reason why instant payment is more and more widespread is because most European banks have chosen automated clearing houses which accelerate the payments, and therefore a large part of them can be processed instantaneously. Now, in the next slide, you will see that the largest interbank network in the EU is called TIPS, and most payments are treated according to the same common technical standard, which is called ICT Inst. Now, this is because instant payment is becoming more popular, that the mobile wallets and the digital wallets will use instant payments as the underlying technology. And merchants will prefer it. Why? Because if they get paid instantaneously, and if they have to pay less commission than with the traditional credit card rail, well, this is a major differentiating factor for them. So remember, instant payment is the major trend in the payment scene, the first major trend. Now let's go to the second major trend, which is open banking. Now, open banking is, as you know, a system where you can choose to share your personal data with several banks. Now, in the US, you have local champions such as Plate that emerge thanks to market forces. But in Europe, and we can see this now, open banking is defined by a regulatory directive called PSD2. In theory, it gives equal rights to any new player in the payment field because banks are forced by regulation to open their infrastructure. On top of this, European passporting means an entity regulated in one country can offer its services throughout the European Union. That means to 440 million consumers with a single regulatory license. However, in implementing PSD2, the European Commission, in its great wisdom, defined the principles but did not define the technical standards, considering that it was up to the market to do so. And so each bank does it a bit differently, which means that the new players lose time trying to connect everything. But here again, market forces are playing, and we have open banking platforms that helps the new player to connect with thousands of banks across Europe. So open banking was the second major trend. Now let's go to emerging trends in the payment scene. The first one is buy now, pay later. Now, you probably know Klarna, which is very successful in the US and which was started in Sweden. But there again, in this map, you can see all the local players in the buy now, pay later field across Europe. And you can see that Klarna is not always the market leader. Why? Because some local players were more clever at seizing the needs of some local national consumer. Also, be aware that a big difference between US and Europe is that in Europe, we don't have a standardized credit score, which means that the buy now, pay later companies, they have to rely on their own risk model or on some local databases. But here again, the level playing field is not harmonized. Let's go to one other new emerging trend, which is the European Payment Initiative. Now, the European Payment Initiative, it's at its cradle stage. The idea is to launch a 100% European payment card and electronic wallet around 2022. Now, don't get me wrong, it's a political project. It's based on the idea of sovereignty. It's based on the fear that an ill-tempered American president could order Visa or MasterCard to cut off payments within a European country or to a European company that US might dislike. You may be wondering, why now? Well, precisely because now we have two blocks to build this system that we didn't have 10 years ago. The ones I just mentioned, instant payment and open banking. So imagine a mobile payment application where the second you initiate a payment, the merchant has instantaneously the confirmation that the money is already on his account. That would be an undeniable differentiating factor. Now, the EPI is a private initiative. It was started by some French banks, and then they formed a club of about 30 banks over 11 European countries. But yes, politically, the European Commission applauds with both hands, and the central bank, the European Central Bank, is also very happy. But at this stage, the business model is not proven, as it will necessitate dozens of billions of investments. And here again, here comes a big difference between Europe and the US. In Europe, the interchange is capped. For example, for a credit card transaction, it's capped to 2%. Now, the revenues of Visa and MasterCard in Europe are very important, but on a credit card transaction, their share is probably 0.05%, which is tiny, which makes that the business case of the EPI is really not proven at this stage. And last but not least, let's talk about digital money and the digital euro. Now, the central bank is thinking about it. Why? To prepare the end of cash. But there has never been so many banknotes and coins in circulation in Europe, by the way. 2, universal access. So give every European a payment account. But by the way, the problem of the percentage of unbanked or underbanked in Europe is really not a #1 issue, because in many European countries, laws will oblige the bank to give a basic financial access. Third objective, make payments easier, because if we all have an account with the central bank, then of course it's easier to organize payments. But here again, as I just told you, instant payments is a reality even without the digital euro. No, joking aside, and the ECB is not hiding it, the ECB doesn't want the competition of a private currency such as Libra, now renamed Diem, as you know, which is far from having taken off, precisely because the central banks don't like it and has prevented Diem so far to be a reality. So in terms of implementation, the ECB might consider to use the commercial banks as a distributor of their future digital euro. But here again, we probably talk about billions of investments, and this is why the European Central Bank has not confirmed yet that the project will go on. This will happen this summer. So, ladies and gentlemen, as a conclusion, I hope that I have convinced you that the e-commerce scene in Europe is big and profitable, and that the payment scene is definitely buoyant, with great opportunities for the players that are willing to understand the needs of the European consumers. Thank you.
Well, thank you very much, Thibaut, for this fascinating presentation, which was obviously not only entertaining, but highly interesting. I myself have certainly learned a lot, and I could have continued listening to you for quite a while, but unfortunately we must end, because we have already taken a little bit more time than we were foreseeing, but I think that is also because the presentations and the speeches by our experts certainly warranted it. Ladies and gentlemen, it remains for me, first of all, to thank all the speakers who were involved in this Focus On episode. I hope that it brought to you the information that you were looking for, and if you want additional information, I can only invite you to go on our website, luxembourgforfinance.com, where you will find all relevant information about Luxembourg and all the links to our partner organizations, such as the Luxembourg Investment Fund Association, ALFI, that many of you will know, such as the Private Equity Association, LPEA, that many of you will know as well, the Loft, and many others, including, of course, also the EPA, just presented by Thibaut. I would also like to thank you for taking the time out of your busy schedules, and I would like to invite you to the next session, the next episode in our Focus On series. And that will deal very much with the topics that we have touched on last, namely Amazonization, that is the platformization of the financial services industry. More on that on June 9th at luxembourgforfinance.com. You will certainly be invited to join us. If not, go on our website and you will find it. Last but certainly not least, let me also thank again our sponsors for supporting us, and my team as well as the technical team here for making this episode here again, at least from a technical point of view, a great success. Ladies and gentlemen, stay safe. See you on June 9th for the Focus On Amazonization. Thank you.